Good afternoon. This is Sean Golding with Golding & Golding, here to discuss a little bit about foreign retirement plans. Foreign retirement plans can be pretty complicated. We've been writing about it for years. We actually recently updated an article. Our original article was back in 2015. We get a lot of questions regarding foreign retirement plans. There's a lot of incorrect information out there and presumptions that taxpayers shouldn't necessarily make because they may not be required to do certain forms. Let's walk through it. Let's go over a couple of examples and take it from there. So first of all, who may have to report their foreign retirement? For individuals, there's basically three categories. There's U.S. citizens, lawful permanent residents, foreign nationals who meet the substantial presence test. With the latter category, common scenario is a person here on a visa who stayed a sufficient number of days to qualify, unfortunately, for or to meet better the substantial presence test, which means they now get taxed the same as U.S. citizens and permanent residents. So foreign retirement plans, foreign pension plans come in all shapes and sizes and all different flavors, right? You could have a investment plan that's wrapped as a retirement plan. You can have an employment type of plan. You can have other types of personal investments that are deemed retirement. Let's go through the basics, right? So someone has a foreign retirement plan and they're doing their taxes and they're trying to figure out, geez, like, what am I supposed to do with this? I didn't get any 1099 or anything equivalent from my foreign retirement plan administrator. How to kind of look at the foreign retirement. So the first thing to consider is it a treaty country or a non-treaty country, right? When it's a treaty country, that means the United States has entered into a bilateral income tax treaty with that country, and oftentimes treaties will provide specific reporting requirements, taxation rules, things of that nature for retirement plans between residents of both countries. So someone can rely on that. Oftentimes it's going to be more beneficial than if there's not a treaty. Example. It's very common for taxpayers from Australia to come to the United States or to live abroad but be a U.S. person for tax purposes, and they're going to have a superannuation. On the flip side, a non-treaty country, a taxpayer may come from Hong Kong or Singapore or Malaysia, have a provident fund. Technically, the retirement's similar, but there is no treaty with that country, so there's nothing specifically to defer the income, and so the tax treatment may be different. Another key issue is employment versus personal. When a person has an employment type of retirement, it typically gets treated better, especially with treaty countries, than if it's a non-retirement. So, for example, a taxpayer may have worked for a specific company or multiple companies and accrued significant amount of retirement similar to like a 401k. Alternatively, maybe the individual worked for themselves or was doing some investing to try to prepare for retirement and may have a personal retirement type of plan, which is essentially just investments, typically funds, unit trusts, things of that nature, wrapped together and called a retirement plan. The IRS isn't a huge fan of those. They typically don't get deferred treatment like your Maltese retirement schemes. So when it comes to, so now you have an idea of your different type of retirement plans. Let me mention one more thing that I get asked about a lot. The IRS has specific information that makes it seem like you don't have to file retirement or pension plans on the FBAR 8938. What they're saying is that if you have like a 401k, a domestic type of approved retirement plan, and in that plan you have foreign accounts, assets, and investments, you don't have to go into your 401k and look through and see, oh, I have a VTI or I have, VXUS, and within there are some foreign funds, so I have to report that. That's not what they mean. So what they're saying is if you have one of these qualified plans, typically domestic plans, then you don't have to report the inner workings of that plan on your FBAR 8938, et cetera, et cetera. It doesn't mean you don't have to report your retirement, your foreign retirement on the FBAR and Form 8938. In fact, if you look at the 8938 instructions, if you look at publication 5569, which talks about FBAR, you'll see they give examples of having to report. So the information is not great. It's something to keep in mind. So the 1040, if you have income, you're going to report it on the 1040. If if you don't have any this is where you have to look to see whether it's a treaty country or non-treaty country, and whether it's personal or employment. That will help determine whether growth is taxable. Distributions are typically going to be taxable, and that's going to be reported on your Form 1040 for the income component. For the reporting, this is where it gets infinitely more complicated. Your foreign retirement plans are going to be reported on your FBAR. They're going to be reported on your Form 8938. Relatively straightforward, asks for maximum balance. You may not be able to get that, so you do the best you can. It's not homework. You don't have to get 100% to move on to the next. You just need to use your due diligence to get and do some reasonable research into what the maximum value may be. Different countries are on different tax years, so in some countries you only get a statement every June, and so you have to kind of work backwards to figure out what the maximum balance was. You just do your best. Forms 3520 and 3520A are kind of the hitch in the giddy up. It's where the complications begin to set in, because these are very complicated forms when you're using it for foreign retirement. So how do you even get to foreign retirement for 3520, 3520A, which is for large gifts, inheritances, and trusts? Hyper-technically, when you look at a foreign retirement plan, it has all the makings of a foreign trust. And since it has all the makings of a foreign trust, sometimes some people take the position that you have to report it on Form 3520 and 3520A. Now, presumably, when the IRS created these ridiculous monster type of tax forms, they were doing it for taxpayers who may have, offshore asset protection trusts or other type of foreign trusts that the IRS has no information about, and they want the information. It wasn't designed for people to have to report their foreign retirement trust. How do you know this? You could go back as 2014. The 2014-55 revenue procedure is a great showcase of how the IRS does not want all of the information for foreign retirement. Here with RRSPs, RIFs, RDSPs, essentially, if you have these type of retirement plans in Canada, then the IRS specifically says, hey, you don't need to report it for 3520, 3528. Yeah, you do have to report it for FBAR and Form 8938, but you don't have to do it for 3520, because it's overwhelming for taxpayers. Tax professionals charge a lot for the forms because they're complicated, and taxpayer can't even get most of the information. Your foreign retirement plan is probably not going to send you the inner workings of your plan. It doesn't work that way. Subsequently, there was something called the Revenue Procedure 2020-17, because the IRS, the Treasury, they don't have the time or the resources to determine the specific retirement plans from each specific country like they did for Canada in 2014-55. So 2020-17 essentially provides taxpayers with a kind of, it's like a catch-all, right? If you meet these specific elements, then you don't need to report your foreign retirement trusts and non-retirement savings plans on a 3520 or 3520A. Of course, it's still required for FBAR and Form 8938. And in 2024, there were some proposed regulations as well, which expands upon Revenue Procedure 2020-17 and really wants to limit the amount of reporting for these types of retirement plans and other type of similar non-retirement deferred sales trust savings. Okay. There is also Form 8621. Form 8621 is used to report PFIC, passive foreign investment companies. Now, PFIC reporting can also get complicated, especially in any year that a person receives distributions from a PFIC, excess distributions, dividends, etc. But there is an exception with 8621, excuse me, when it's a treaty country. Certain types of pension and trust do not require the taxpayer to parse out the information. Of course, if there are excess distributions and things like that, it may still be required, but from a baseline perspective, taxpayer may be able to sidestep that requirement. For taxpayers who are out of compliance for reporting their foreign retirement plans, we have a ton of free information available on our website. There are many different offshore amnesty programs that taxpayers can submit to in order to get into compliance. There's the voluntary disclosure program for taxpayers who are willful. There's the streamlined procedures, delinquency procedures, and reasonable cause for taxpayers who may qualify as non-willful. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.